Rob Berger, and if you can tell, I'm not alone. I have the father of the 4% rule, Bill Bengen. Bill, welcome to the show.
Oh, thanks for inviting me, Rob. Glad to be here.
Well, I am thrilled and honored that you could take some part of your day and spend it with us. For those in the chat, if I can get a thumbs up that everything's working, you can hear and see us. And if you want to ask Bill some questions, just tag me, my name in the question. Bill can't see them. I've got, of course, as you can imagine, I've got my own list of questions for Bill. And so I'll get us started. But if we have time, I will go through the chat and look for questions. And Steve, thanks for the thumbs up in the chat. I see that. So Bill, I kind of want to just dive right into the deep end. So,
sure.
There's been this question given stock valuations and inflation, is the 4% rule still valid today? And I know you've talked about that. I know Morningstar had a report. You've talked to them. Mm-hmm. I kind of want to approach this issue from a slightly different perspective, I think.
Sure.
In your work, and I was actually reading the paper you published just about a year and a half ago, choosing the highest safe withdrawal rate at retirement. Mm-hmm. You pointed out then that sort of the absolute, if you just got so unlucky over the last roughly 100 years, October 1968, not a particularly fun time to retire. That was sort of the worst of the worst.
That's right.
And that's what gets us the 4% rule, or maybe the 4.5% rule. We'll talk about that.
Sure.
So I'm trying to imagine, what would have to happen today and over the next decade, let's say, for us to have a new 30-year period. I don't know when it would start. Could be this year. Could have been, for all we know, maybe it started 4 years ago, right?
Yeah.
That would turn out to be worse than 1968. I mean, wouldn't we need like a decade of really bad inflation?
Yeah, I think that's what would do it. I'd be more concerned with that, the inflation, than I would be about an extended bear market. Bear markets start and they run and then they end. And then, the markets then recover. But you get an extended period of very high inflation. And the retiree then has to jack up his withdrawals each and every year. They never come back down to the original level. They're stuck with it for the rest of retirement. So really, inflation is a scary thing for retirees, and it's probably the greatest threat to the future of 4.7% rule, whatever you like to call it today.
Right. Yeah, because I think you actually mentioned this in that 2020 paper. You can lose money in the stock market, but as you said, at least if history's a guide, it recovers and goes higher, right? But unless we have an extended period of deflation, which really hasn't happened in modern history in the US, and we've had a few years, of course, Great Depression comes to mind, but unless you have a long period of deflation, those high inflationary periods sort of get locked in.
That's right.
And then as you take more and more withdrawals, it kind of just compounds and gets worse and worse, even if inflation down the road moderates.
That's right. And that's been concerning me for quite some time because, you've heard a lot of noise from central banks being concerned with low inflation and deflation. So they've been trying for just some years to raise the inflation rate, and by gum, they succeeded beyond everyone's expectations. Now they're in a struggle to try and bring it down. I think that's going to be a tough battle, and that's not good for all retirees.
So, do you have any way for those folks that are retired or near retire or about to retire, and they're thinking of following something like the 4% rule, which is, as you know, is not the only way. You could do a dynamic approach, which we'll talk about, but the thing that I think people ask me the most is, if I'm going down the path of 4 or 4.5%, and I'm taking an 8.6% adjustment this year, if that's what it turns out to be, that's a big adjustment. How many years of high inflation have to occur before I should really start to worry?
Yeah, I think, if we go on deep into this decade with these kind of inflation rates and they're resisting attempts to reduce them, we should all be very concerned.
Yeah.
And I sure hope that doesn't happen, because I'm a retiree myself now. I've got a bullseye on my back now as far as inflation is concerned. But yeah, if you get down in another 6, 7, 8 years of this stuff at 8%, that could really be painful.
Yeah, I was looking at the numbers in the 70s and into the early 80s. And of course, some years we had 10, 11, 12. But, there were plenty of years, or a number of years during that decade that were 6%. Mm-hmm. Kind of range from like a 6 to 10 or 6 to 12. So yeah, 8.6, I guess if it persists 3, 4, I get maybe 5 years, then what do you think people ought to start doing
Well,
if we get to that point?
I don't think they should wait, myself, in my opinion, for 5 years. I think
Okay.
uh, that if they wait 5 years and they get the bad result, it's probably too late to make an adjustment. With inflation, my studies show that the sooner you make an adjustment, even if it's a temporary adjustment, the safer you'll probably be. So if you cut your expenses now and when inflation gets beat back in just a couple of years, you're okay. You can go back to a higher level of expenses. But if inflation continues, you're prepared. You brought your expenses down and should be able to survive.
Okay, so like, would this be one way to think about it, to say, and I know Michael Kitces, I think, sort of, I don't know that he back tested it, but he sort of proposed this idea, was that you would calculate your inflation adjustment every year, like you've described,
Uh-huh.
but then before you pull it all out and go spend it, you'd figure out what percentage of your portfolio that actually represents. And if it's, say, above 6%, then you say, okay, I'm not going to take all that. I'm going to bring that number down so that I never take out, let's just say, 6% of my portfolio at the high end. Is that kind of one way to curtail the spending, or do you see maybe doing it a different way?
Yeah, it is. Although I haven't tested that particular approach with my own system. I found out, my methods basically, when a person retires, we try to find a historical equivalent to what the conditions they face in retirement with respect to inflation and with respect to stock market valuations. And that could be any year. It could be 1947, 1962. And then we use that as a template. And then they track their portfolio against what happened to that investor. And it's in the past, it's possible that because of an early bear market, your withdrawal rates could look like they're going up 7, 8, 9%. It could be concerning. But because the stock market recovers, they can come back down very quickly. So it's hard to pick a particular number like 6%.
Yeah.
Because it varies so much depending upon market conditions. But inflation is something you need to deal with now, even more so than bear markets. Once again, bear markets are temporary. Inflation is forever. So it's just something you just need to take an extra degree of caution with.
Yeah. So that's interesting. The idea of, go ahead.
I'm sorry.
Okay. The idea of taking the current, 2022 and trying to find some historical parallel.
Yeah.
I know one thing to look at would be stock valuation, right? So maybe you use the CAPE, maybe the CAPE, the cyclically adjusted PE for stock valuations, or would you use something else to sort of find a comparable stock market?
Yeah, my research I did about a year and a half ago indicated that if you use the CAPE, the PE ratio of the stock market at the time of retirement, and couple that with what I call the inflation regime, what range of inflation, you win low inflation, maybe no more than 2.5%, or medium up to 5%, or higher than that. And you use those two factors. I developed a series of charts based on what happened historically. If you use the historical data, you can determine what your actual safe withdrawal rate should be to a pretty high degree of accuracy, about 90%, based on history. And it allows you now to get away from the 4.5%. If you retire in good circumstances, let's say the market bottom in 2009, where stocks were cheap, I figure you could have taken out 6.5% based on historical precedent. And that's a big jump, from 4.5%. That's worth looking for.
Yeah, for sure. Well, I'm very familiar with those charts, and I will leave, for those watching, I'll leave a link after we're done. I can't do it now, but I'll leave a link to Bill's paper that has those charts in it. The bad news for those watching is if you follow that, you're pretty much stuck at the bottom, I think, right now. Isn't that right?
Yeah, the needle is jammed against the low end of and it's been like that for most of the last 20 some years, because stocks have been so expensive for such a long time compared to historical precedent. I guess we'll find out if they really are a mean reverting series or not.
Yeah. We'll find out, but it'll be too late to do anything about it.
Yeah, we'll see. I'm excited if stocks got down into the teens again. It'd be a great buying opportunity. I don't know if we'll get there, but
yeah. So for that paper, and I know you built on what Michael Kitces had done. in terms of, he didn't, I don't think, factored in inflation like you did, but he looked at CAPE and he saw that inverse relationship is pretty strong, a negative correlation. I'm curious, did you test it against just a standard current year PE, or did you just look at it from a CAPE perspective?
I like the CAPE because it smooths out variations, in earnings over a long period of time, and that seemed to me to make a lot of sense.
Okay.
Rather than using current year PE, because stocks are basically a claim on a stream of earnings going far out into the future, and to use just 1 year's number doesn't seem too useful.
Yeah. So, we've talked about 4.5 instead of 4, and I think at one point your data showed maybe even 4.7 being what you've called, I think, max safe, the maximum, safe starting withdrawal. But that requires an asset allocation a bit different than in your 1994 paper, which, as I recall, was basically just S&P for stocks and intermediate term treasuries for bonds. Since then, you've looked at, for example, adding small cap.
That's right.
Right.
International stocks, micro caps, mid caps, and so on. Trying to approach something closer to what an individual or professional investor would have in a diversified portfolio.
So have you, and I know everyone's different, there are different risk tolerances, everyone's situation is different, but have you settled on any sort of asset allocation, or, how much in small cap, or, again, I know there's not one answer to that question, but do you have sort of your own sort of preferences?
Well, my research indicates that I'm studying with 5 stock asset classes now. That's my latest round of research. Using the equal amount of each, it's pretty close to optimal. If you're using a 55% allocation of equities and 11% in each, because it's hard to predict, where each asset class is going to be at the time of retirement with respect to its long-term cycle. So that just seems to work out best.
And the classes would be S&P, which is basically large cap, small cap. Did you say micro cap?
Micro cap, yep. Mid cap.
And those are all US based.
That's right.
And then what, international and emerging?
International, actually mid cap, US mid cap.
Oh, mid cap. Okay.
Yeah.
Interesting.
I guess it's included in the international equity component.
Right. Okay. And you mentioned 55% stocks. I know in your original paper, as I recall, it was, you should be somewhere between 50 and 75 and as close to 75 as you can tolerate. I'm right. Paraphrasing. I think that's basically right.
That
is that still your view today?
As I've added asset classes, I've actually found the optimal equity allocation is a bit lower, somewhere between 50 and 60%. I use 55 as a good medium. It's just that because you have those other equities generating higher returns, you don't need to go as high an equity allocation as I originally discovered. Okay.
Now, so you've mentioned, the business, the size of the company, right? Micro, small, mid cap. Does your research show any preference to value or growth?
No, actually, I haven't looked at that aspect of it.
Okay. All right, good. I'm curious, just to kind of step out of the weeds for a moment. When you published your paper in 1994, first of all, I'm going to guess you couldn't imagine that we'd still be talking about it 30 years later. I don't know. Maybe you knew it was going to be a hit. I don't know. But what was it a hit immediately?
In some quarters it was. In others, I generated a lot of hate mail.
Really? What was the hate mail about?
The hate mail was basically from people who had, prior to my research, there really was no guidance for people to recommend to clients what the withdrawal rate should be. So they did the best they could and generated their own rules of thumb based on their thinking. Some people thought, well, stocks return 10%, put a lot of money in stocks, you should be able to take 7%. Shouldn't be a problem. And other folks said, oh no, you're in retirement now. You have to be totally conservative, go on, all in bonds, no more than 2.5%. Of course, neither one is accurate. It's somewhere in between. But there are people in both camps who were advisors, who had been advisors for many years and didn't appreciate that an upstart young advisor who just joined the field was coming out with something completely different than be telling their clients, and made, embarrassed. So I got hate mail from those folks, but most of the people seemed to be grateful that there was some at least scientific basis now for the recommendation that they could show their clients, and
Right.
became successful from that bet.
So it seems to me that throughout your these years, and you've published a number of papers. I think I've read them all. It seems to me that you're always focused on total return as opposed to trying to have some sort of income strategy, maybe tilt a portfolio towards high dividend paying stocks.
Mhm.
Is that your general approach, to focus on total return? And what do you think about the idea that you should try to generate more income in retirement?
Yeah, I have focused primarily on total return. Although, I break the components into uh, dividends and appreciation. I don't think there's anything wrong with using a high dividend stocks as long as the total return is the same. And it may be a benefit that the sense if you're in a bad stock market decline and you still portfolio is still generating some decent income from those stocks, it may allow you to stick to your plan better than somebody who's old growth stocks with zero dividends and sees their equity melting away day by
Yeah,
day and panics and sells. That's not good.
it definitely could be some behavioral advantages, I guess, if you don't take it too far.
Yeah, I
Yeah.
agree.
Okay. Uh, I'm curious. So again, the approach that you've always modeled, at least as far as I can have seen, is you start with some percentage that you take out in year one, and then you adjust for inflation thereafter.
That's right. You
Uh,
just throw away that 4% after
yeah,
the first year. Just as
which I
correct.
think is something that a lot of folks don't appreciate at first when they hear the four. They just think they take 4% every year, which is actually probably the polar opposite of what
Yeah,
you
it has
know.
a different effect. Yeah.
Yeah. But as you know, there are a lot of sort of, I would call, I kind of view that approach as a static approach, in the sense that the amount you're taking out is the same every year on an after inflation
Mhm.
basis. But there are a lot of dynamic approaches, right? Guyton Klinger have published on it. I think maybe Wade Pfau has done some work on it, where, depending on what's going on with inflation or maybe what's going on with the market, you may deviate from an inflation adjusted amount every year. Maybe you put a cap, something, right? Do you think any of those have merits? I mean, in your work with clients, for example, did you ever recommend a sort of some sort of dynamic approach to calculating the withdrawals each year?
No, I'm not specifically in some organized manner, although, it just seems to me to make sense that if you're in a steep stock market decline, it just, would pull your ears in a little bit, cut back your expenses just in case this thing really gets much worse than anyone can imagine. And then as the thing recovers, return to normal. I think that's pretty much in accord with how human beings feel too. If they're in
Yeah.
a bad stock market, bear market, they feel less wealthy. They want to spend a little bit less, protect what they have. And I think that's wise.
It would be interesting. I don't know of anything like this exactly, but if there would be some method one could use to calculate, given the circumstances, I should pull back this much,
Uh-huh.
some sort of, guideline.
Yeah, that's an interesting topic for research. Maybe I'll take a look at that in my next round of our research. It's a good suggestion.
Well,
Uh,
I look forward to that.
yeah, it's that will take some experimenting. Trying to try and error probably see what works. But the advantage of my method is, theoretically, you don't have to do anything.
Yeah.
If you're picking your withdrawal rate, you should be able to have confidence that markets will adjust and come back and bring you back to a healthy position. So it's a long-term plan, versus short-term concerns.
Right. Right. Okay. One other topic kind of related to this is the question of investment fees.
Okay.
So in your research, you have the returns for the different asset classes. You don't, at least that I've seen, you don't subtract any sort of investment fees, whether it be an expense ratio of a fund, for example, or an investment advisor's fee. I suppose if someone's using low-cost index funds, those fees might be more or less negligible, I suppose, if they're maybe a few basis points.
Mm-hmm.
But how should folks think about, I'll call it, I guess, the 4.5% rule, if that's what is that what you think it is now? Is it 4.5?
4.7% for a 30-year
4.7.
portfolio out of a tax deferred account like an IRA. Yeah.
Okay. And I want to come back to the point you just made about tax deferred accounts, because that's important. But okay, so for someone with a 4.7, following the 4.7% rule, but say paying an investment advisor, whatever, 1% a year, how should they treat that? How should they look at that?
Well, that 1% is an expense. And basically, I don't look at how people spend their money. I just look at the maximum amount they can safely take out to cover all their expenses. So people have to be careful about what they spend, on everything, including investment advice. So because that's going to reduce what they have to spend on other things.
So would the right way to think about it, say if someone's got $1 million, they're following the 4.7 rule, percent rule, it's year one, so they take out 47,000. And if they're paying an advisor 1% of $1 million, that's 10 grand. So they basically, out of the 47, they got to pay their advisor, that's 10 grand.
That's right.
And they have 37,000 left to spend. Is that the idea?
That's exactly right.
Okay. So I want to go back to the tax deferred aspect. What applies if it's a taxable account? Do you still have the 4.7% rule? You just have to pay taxes out of it, or how does that work?
No, I've calculated for taxable accounts using different rates, and it's generally about 10 to 15% less. So it'll be, somewhere around 4%, 4.2%, depending upon the actual tax rate, the individual is experiencing. So it is significantly less.
So if I had $1 million in a taxable account, if I understand you, I could take out, let's say 40 to 42,000, maybe depending on my tax rate.
Okay.
Would I have to pay the taxes out of that amount, or could I pull the taxes out of the $1 million as well?
Well, my research assumes that the portfolio pays whatever investment taxes are done. Okay. So if it's a tax deferred account, no taxes are owed until you withdraw. But after you withdraw, that's something I don't concern myself with. But for a taxable portfolio, each year you're taking out taxes on capital gains and dividends and interest. And so forth.
Okay. And I guess for maybe, I don't know, for most people, but they're probably in a more complicated scenario where they've got traditional, they've got Roth, they've got taxable.
Mm-hmm.
How do you sort of think about the Safemax, right?
Sure.
When you've got all different kinds, maybe you have HSA money you're spending, it's tax-free, assuming it's for medical expenses. How do you sort of wade through that as the account types get more complex?
That's where you really need software, financial planning software to test various scenarios, which is the best account to take out from first, and so forth, and apply. It does get a lot more complicated.
Do you have any favorite software that you use?
No, I just use a spreadsheet pretty much. I used to use Money Guide Pro when I was practicing. I really like that software. But, it's been 8 years, so 9 years now almost since I retired. So I really am not up to date on financial planning software now.
So when you're testing all of the different asset allocations and scenarios, you've basically got one big spreadsheet with all the historical returns for each asset class, and you just calculate it that way?
Yeah, I have multiple spreadsheets actually, because some of them my spreadsheets in some cases getting so big, they're taking like 20, 25 seconds to load and recalculate and save. So I have to spread my research out over multiple spreadsheets so I can test each aspect separately, to come to conclusions.
I hope you save those forever, because someday they need to be, I don't know, the Smithsonian or somewhere. Those spreadsheets need to live on.
Get them bronzed like baby shoes.
Yeah. That's interesting. So I know for a consumer, you don't have access to Money Guide Pro unless you have an advisor that uses it.
Yeah, I probably subscribe myself to the software.
Yeah. I know for those folks without an advisor, On Trajectory and New Retirement, or just for those listening, are two packages that I'm pretty sure can handle order of withdrawal from different accounts. So Well, I want to touch back on asset allocation, and I'll turn to the viewers' questions here in a minute. But there are some withdrawal methods, and I know Guyton Klinger's done some work on this, where they say, because I think in your approach, you take your withdrawal out and then you just rebalance each year. But what some will kind of come up with is trying to figure out how to take from different asset classes and maybe not rebalance.
Okay.
So maybe you just take from the asset classes that are up that year. And if there aren't any, you take from cash if you have any. And if you don't, you take from fixed income. Have you ever sort of tried to back test those sort of more, I guess, more complicated withdrawal approaches?
No, I really haven't. I guess you can, reach infinite degrees of complexity if you want to stay. But, my approach tends to withdraw money from the asset classes that have risen the most during the year because I'm going to be rebalancing,
Right.
So it's kind of a natural thing. And that's one of the reasons why the portfolios do so well. They're rebalancing adds significantly to returns over time.
Right. Yeah, and that's something that I think trips some people up. Because I don't know if you're familiar with the bucket strategy, but the idea is you have a cash bucket, a fixed income bucket, and a stock bucket.
Yeah.
And I'm actually talking to sort of the person who originated that on Wednesday. I have Harold Avensky. He's going to be on the show.
Oh, good.
But I found, for me personally, his approach is just a 2-bucket approach, I think. But some have proposed 3 and 4 buckets. And I found, for me, just rebalancing, kind of what you've described, is just a little easier because you end up, except for maybe this year, you end up, selling high and buying low, which is kind of what you want to do, right?
That's the beauty of rebalancing. It accomplishes that for you automatically.
Yeah.
So
yeah. Okay. So let me pull.
It's simple, quite frankly, because investing is a complex area to begin with, and make it any more complicated than it is trying.
Well, and to that point, Bill, and I know this from experience now, it turns out that accumulating is much easier than actually decumulating, right? I mean, and because when you get to retirement, at least for me, it was really scary, the idea of spending my money. I don't know. For you or your clients, how do you deal with that fear that some folks would have?
Well, I had confidence in my research, and I knew what had occurred historically. So I didn't see any reason that it wouldn't work, for the future as well. But, right now we're in a period which is kind of scary because it may exceed anything that's happened historically. So, it's troubling.
Yeah.
It's a troubling time.
So one person, Josh, was asking, and I get this question a lot, how should we think about the 4% rule when we have other sources of income? Obviously, Social Security comes to mind, but some people have a pension. So you've already got these other sources of, I'll call them guaranteed income. I don't know, can we call Social Security guaranteed income? I think we probably can, but
for the time being, like 15 minutes.
For now. All right. So how do you work those kinds? How does that affect the 4% rule? How do you think about that?
It really doesn't, because my research is based upon trying to determine the maximum you can get out of any portfolio. If you think of your portfolio as a cow, if you wish, and you buy this cow at the start of retirement, and it has to supply milk to you for the next 30 years. Okay. Basically, my research is for the care and the feeding of the cow. What do you have to do so it'll give you milk for the next 30 years? And
Right.
I'm not too concerned that you might have, a goat that gives you milk over here, and something else that might give you something, cheese and so forth. Because most people, quite frankly, are not in a position where they don't want to get the maximum from everything they have. Okay. So they're going to take their Social Security and their pension and their annuities, and then they're going to try and get everything they can out of the portfolio to give them the best lifestyle they can. Some people are lucky. Some people can take out 1% and do just fine and have a life, but those are such a small minority. I didn't direct my research toward them. I did for the majority of folks.
Yeah, I mean, I've read some on what some call the perpetual withdrawal rate. How much can you take out every year and basically never, what percentage, and never run out of money.
Uh-huh.
But I'm going to guess that if someone's at 3% with your research, in year one, they pretty much got the only thing they've got to worry about is a future that we can't imagine, at least not based on history.
I think I calculated what I call a Methuselah investor who's going to live 900 years, probably down around 4%, from 4.7 to go down about 4%. Money would pretty much last forever.
Yeah, yeah. And just looking at some of the questions in the chat, what misconceptions have you read or heard about the what do people get wrong about the 4% rule? I mean, you mentioned one where they think it's just 4% every single year.
That's right. Yeah. Some people don't realize that with the 4% rule, you could run out of money with your last breath on the last day of the 30th year.
Yeah.
Okay. So if that's the case and that concerns you and you want to have some kind of guaranteed balance left in your account, as a safety measure, you might want to take out a little bit less, take account for that. Some people forget about the taxable account issue, that withdrawal rates are much lower for taxable accounts. And there are other considerations too, like if you don't get the same kind of investment returns as I assume, and I'm assuming the use of index funds, that match certain large asset classes. If you play with your portfolio and instead of getting 10% for, you get 9%, you're cutting into your withdrawal rate quite a bit. I have to be careful of that. Some people are successful and can earn higher returns, but not everybody's Warren Buffett. So,
right, that's true.
So those are the biggest I can see.
Yeah. One story that I've read is actually about your investments. I think you've discussed this, that you've moved a lot of your investments to cash.
Yes.
Is that true? And what, if to the extent you feel comfortable sharing, what prompted that decision?
Well, I use a third-party service, a risk management service, to help me determine what allocation, my in equities I should have at any particular time. And they've been very good. They've been doing this for many years. They got people, completely into cash before the 87 crash, and they lost only half of what most investors lost in the big bear markets we had earlier in the century. So I depend upon them. And then because I'm just a conservative person, I tend to allocate even more conservative than they recommend. That's my choice, So yeah, I have large amounts of cash, over 50% cash in my portfolios now, and probably another 20% in CDs. So I don't really have much in risk investments at all. And everything today is a risk investment, not just equities. Bonds can be considered a risky investment at this time.
Well, I'm going to say this year you're the smartest guy on Wall Street.
Well, the luckiest guy, maybe.
Okay, yeah. But some would say, well, wait a minute, Bill, that means you're just a market timer. I mean, would you say no, or yeah, that's right, I am, but I'm a smart market timer, or how do you see that?
No, I think market timing to me is somebody who tries to catch the absolute tops and the absolute bottoms of market movements and then move all his funds in and out at that point. That can't be done reliably. That's been demonstrated many, many times. But market risk management involves making incremental moves in your allocation as your perception of risk in the market changes. It can be up or down. And what I like about the particular service I use is that back in 2009, around March, they had been keeping investors very light. They made a big move back into equities as they saw things starting to change. So it's important that you have a service that can do both. It's one thing to get out of the market and save money, but you got to have the other end of it to get back in to capture the upswing.
So how long have you mentioned that you use a service to help you do this? Do you mind sharing that service or the name? Or
Investech. They're based in Whitefish, Montana. That's Jim Stack.
Okay. And how long have you been taking this approach to your investment portfolio?
I found out about them during the 2008 crash.
Okay.
A little later than I wished. I wish I had learned about them earlier. So I've been using them, I guess, about 13, 14 years.
And have you
It's
Sorry?
they
Okay.
have so much profound accumulation of market knowledge and patterns, which they share constantly, with their subscribers. It's just fascinating to read their material.
Huh.
And that they've been right.
And the name is Investech. Did I get that right?
Like Investech. Yeah.
Okay. Okay. Investech. Have you back tested? Have you looked at your portfolio and said, okay, but let's say I just was a simple, kind of portfolio in your research, maybe. I would have done this well since 2008, but I've used Investech and I've done this well. And have you done any back testing?
No, I really haven't. But I can see the results of my I mean, I'm down only about 4% this year, which is not bad. I think most folks are down probably double digit if they're using 60-40 portfolios.
Right.
And if I follow them strictly, the probably loss would be a little bit bigger, but probably be well under 10%, probably 7 or 8. So, they do the job. I can see how what they do works. And it eliminates a lot of the emotion. Bear markets can be a very emotional times for people, and they can start doing really bad things. If you have a service that's disciplined and roots their discipline in history, and it just relieves you of that emotional burden. Just let it ride. Just follow the recommendations and feel good about it.
Yeah. Do you only do this in retirement accounts, or do you have taxable accounts and you just pay the taxes on when you have to make a change?
Yeah, I do it in all my accounts. Yeah.
So you're paying taxes, obviously. If you have gains, you're paying the tax on it.
True, but sometimes they don't necessarily recommend you sell equities. They'll recommend buying a short fund to offset their equity allocation. So that it's not necessarily selling. And they're doing that right now, in fact.
So have you ever? So that all these questions start to come to mind. Do you know what your weighted average expense ratio is? Because those short funds, depending on what they are, can be expensive.
Yeah, they seem to track the market fairly closely, though. I haven't seen anything in them, their performance, which concerns me.
Yeah.
Not the leveraged ones. Stay away from the 2 times and 3 times stuff. Just the plain vanilla. SH for the S&P 500, let's say.
It would be interesting. I don't know how far back you could get data on Investech, but it'd be interesting to if the data is there to see what the safe withdrawal rate would be if someone were following Investech for however many years. Going
That's
back.
Another one. You come up with some great ideas, Rob, for research. I really appreciate it. I'm writing down as we're talking here.
To the extent that I can check your spelling, I would be happy to collaborate with you on any of this. So one person wants to know, what if we experience sort of a Japan-style period of stagnation, even deflation? How do you think, as I'm starting to think of the answer myself, but how do you think that would affect safe withdrawal rates?
Well, I guess Japan's had a pretty rough record of investment returns in stocks since 1989.
Yeah.
They reached that bubble, and the bubble has taken 30 some years to unwind. It would not be very pleasant for investors, to say the least. I hope we don't get into that for an extended period of time. That's awful.
Yeah. It's interesting. Warren Buffett made this point. I can't remember if it was this year or the previous year. When you look at the 10 largest public companies in the 1980s, it's dominated by Japanese companies.
Yeah.
And of course, today, none, I don't think. So that's kind of an amazing change. It seems to me the U.S. is far more diversified, but maybe I'm just trying to be an optimist. I'm not sure.
Well, you have to be careful about bubbles. They're almost always built on false assumptions and false hopes. And, I'm fairly convinced we're just now on the downside of a huge multi-asset bubble, the biggest perhaps in history. So I don't think these things unwind in a few months. I think some people are hoping we'll have better returns later in the year. I don't know about that. You've got bubbles in real estate and stocks and fine wine and art and Mickey Mantle baseball cards and stuff like that. I know the baseball card market, from what I'm told recently, has started to collapse. They got the ridiculous prices. So there's a
I have
lot of things that are getting hit now all at once.
I know I have some friends that have quite a substantial investment in baseball cards.
Uh-huh.
Um, it seems to me that the one common denominator, whether you're talking baseball cards, bonds, stocks, or Bitcoin, has been basically free money, both
Yeah,
fiscal and monetary policy. And as
speculation.
that unwinds, don't I mean, generally, isn't that going to bring most, or if not all, maybe not energy right now, but all asset classes down?
Yeah, I think that's happening now.
Yeah,
Real estate, I think you'll see sometime the next year really start coming down hard. Uh, and that's going to shock a lot of people, because they had a decade of constantly rising prices in just about everything they owned. And that's
right.
not normal.
So you mentioned, you have a lot in cash. I think you said certificates of deposit. Do you have any money now in stocks?
Uh, Maybe a net of about 4 or 5%. That's it.
Wow.
That's it.
Okay, so you've got cash, which I would include certificates of deposit, I suppose, right? What else do you have?
Cash certificate pop. I have some small position bonds, and I have stocks and a short position stocks, which brings my net equity allocation down to about 4 or 5%.
I see. Okay. Any IBonds in that mix?
No, I really haven't gone into that.
It's hard to because
Very well. I guess they're paying very high interest rates right now, but
yeah,
I don't know if that'll persist.
right, and it is kind of a challenge because of the limits in what you can invest each year.
Yeah.
So let me just go through the chat here, and we've talked about income investing versus total return. Are your stocks, by the way, that you have, is it just a basic? I know you have some short positions through funds, so your net is 4 or 5%. Is it basically index funds?
Yes, pretty much. I don't see any particular individual stocks right now that I feel like I want to invest in. So funds are fine, And I think
Okay.
most of the time I probably will invest. If I can get the market return and avoid big losses during a bear market, I'm a pretty happy guy. I'm not greedy.
Right. Okay. Just going through the chat here to see if there's anything else. A lot of people, you mentioned international stocks.
Sure.
And a lot of people, I get this question all the time, Rob, why do you invest in international stocks? They've been terrible compared to the US for, pick your time period, certainly recently. But what are your thoughts on whether a diversified portfolio should or should not have exposure to international stocks?
Oh, I think it should. Over the long term, you really can't tell what will happen. We've done certain things in this country, with our fiscal policy and with our monetary policy. We're lucky we have a rising US dollar, to support us now. But I wonder how long that will continue. When that reverses, you probably want to be glad you have some money in international stocks. So
Yeah.
never tell when that'll turn. So that's the principle of diversification.
Well, the high dollar, the value of the dollar right now, as compared to other currencies, is actually a bit of a concern, particularly for those countries that are borrowing in dollar-denominated bonds.
Yeah, emerging markets and so forth. Yeah.
I mean, I remember 1997, I think,
Yeah.
was pretty ugly for this very reason, as I recall.
It's going to get ugly again, probably.
Yeah, I laugh. I'm not sure that's funny, but I guess what else can you do?
Just these things just repeat themselves because of human nature, I guess. That's what behavioral finance is all about, right? We're going to continue to repeat the mistakes of the past, except for a few who managed to sidestep them.
Yeah. I kind of want to just jump back in real quick on something else, and that is this idea of static versus dynamic withdrawal strategies. Because, the research says that most people spend less money as they age. They may spend more on healthcare,
Okay.
But they spend less on other things. And so their overall spending, again, there's always exceptions, right? But tends to go down when you get into your 80s and 90s. So how should folks factor that in? Does that suggest that maybe a dynamic strategy for some might be a better approach, where maybe you spend a little more in your first 10 or 15 years and less later? Or did your conservative side kick in and say, no, we don't want to do that?
Well, it depends on you. I've studied some situations where people spend more heavily upfront retirement because they want to travel and do other things. And when you do that, when you front load your expenses in retirement, you really pay a price for the withdrawal rate later because you've diminished your portfolio so rapidly now at the front end. You're going to have to accept a much lower withdrawal rate, so you're going to have to figure out what you can live with, on both ends.
Yeah.
But it's a tricky business. I think I don't necessarily accept the fact that people will spend less later in retirement. It depends upon the individual. For example, I, like a lot of people, like to gift my children, and I build that into my expense budget. So it's part of my 4.7% rule. It's part of the money that I take out. And if I end up doing well, I'm going to try and increase my gift. So over time, I'm not going to be spending less. I'm going to be giving as much as I can to my kids, which will keep my expenses higher. So of course, I had to go with high medical expense. I'm pretty healthy, but that can be a practice for some people as they grow older.
Well, sort of a related idea, a question that I've received a lot is someone who's going to retire, let's say they retire at 60, they're not going to take Social Security until full retirement age at 70, or at the highest level. So they've got 10 years before Social Security. So the question I get a lot is, hey, can I take out a higher percent to start with, whatever, let's say it's 5.5%. For those first 10 years, because then I'll cut back when Social Security kicks in. Is there any sort of validity to that sort of thinking?
Well, there might be, but once again, you're front loading your expenses at a higher rate. So you're going to have to run the numbers actually in a spreadsheet or using financial planning software to see what happens after 10 years, how much of a decline you have to take in your withdrawal rate to make that work.
Yeah. You mentioned that you still are doing research, and I guess maybe you're working on more papers, I hope.
Well, actually, I'm updating my book. I published a book 16 years ago which summarized all the knowledge I had then, but there's so much happened that I've done and other folks have done since then that I feel the need now to rewrite it completely, and for the first time, with that discovery I made a year and a half ago, bringing inflation into determining the withdrawal rate, I now have a complete systematic methodology of recommending a withdrawal, which I didn't have. The first 25 years of this research was very frustrating because I had no way of recommending to anybody what was the safe withdrawal rate based on what today, if it's 1982 or 2012, what should it be for? I know the safe rate, but can't we do better than that? And now I know how to do that. So I want to lay that all out. So for the benefit of my fellow advisors and other folks who just might want to use that, for their own purposes in the future.
And that will be in a new edition of your book?
Yes, I'm writing it now. Just slow. I have to do the research and then write the book. So
yeah. Do you have any idea of when that will be coming out?
I'd hesitate to guess. I'm shooting for next year. I'd like to think I can get out next year.
Right. Okay. Well, what have I not asked you that I should have? What topics on the 4% rule do you think it's important for those listening to keep in mind? Or
well, I think you've been pretty exhaustive in your questioning on the topic. I just think people need, when they have a withdrawal plan, they have to realize that it's something that should be reviewed perhaps every 4 or 5 years, just like any other aspect of financial planning, your estate plan, your insurance plan. You need to take a look at it and see, is your withdrawal rate still within a safe corridor, let's say. If not, you have to make adjustments. And it doesn't mean you have to come down. In some cases, you get lucky and you can raise it. People in the late 80s who retired when stock market valuations were still pretty reasonable, had an enormous tailwind for the next 30 years.
Yeah.
Tremendous increase in valuation, so that they found out that they were accumulating huge amounts of money and they could have taken out a lot more than they started with. No way to know that at the beginning. But if they reviewed their plan every 5 years, they would see what was happening and be able to make adjustments and maybe enjoy their life more, sooner.
Right. Yeah, for sure. Well, Bill, for those listening, I'm going to stay on this live chat for a bit, but I will let Bill go. I again appreciate your time today and sharing your thoughts on all of this. And it's perfect timing, for better or worse. They say, Chinese curse, may you live in interesting times.
Yes.
Well,
We
I
have it.
suppose we are when it comes to the 4% rule. So I appreciate your time today.
Thanks. I really enjoyed it. I wish the best
All
of
right,
luck to
Bill.
you and all your listeners.
Thank you so much. Take care.
Bye-bye now.
All right. Fascinating. I will get back through some of your questions. I asked a number of them. I'm sure I've missed some really good ones, and I'm sorry for that. I find some things very interesting about the conversation with Bill. He's gotten some criticism that, for going to cash, and and I want to look into Investech. I think I've heard of it. It's not a service that I personally would ever use because it's just not. I think the odds of particularly on an after-tax basis, for me, I think the odds of that outperforming just a buy and hold are probably pretty slim. But there's really a more fundamental reason. One of the things that Bill said about that was it gives him peace of mind, and that's important. I mean, we don't want to get peace of mind if it requires us to do something that's bad for us. But for Bill, it's worked, and that gives him peace of mind. For me, it's actually just the opposite. What gives me peace of mind is buying and holding. And certainly, in a taxable account, I don't want to trigger a lot of taxes. But what was interesting is he's got some long and short positions, but the net effect is he's got almost no stocks. And, I guess that's contrary to what he says in his papers based on his research. But it kind of reminds me, oddly enough, of Suze Orman. You say, wait a minute, Rob, you lost me there. She got some grief years ago because I think she had like 20 million invested and it was all in bonds. And people were like, that's crazy. But she made the point then, as I recall, was, look, I just want to be safe. I got plenty of money. I'll be good. I'm good. I've met my financial goals. I don't need to take on more risk. One could argue that having all your money in bonds is actually more risk than a 50 or 60-40 kind of portfolio, just a different kind of risk. But, if a person's meeting their goals and can pay their expenses and live the life they want, and as Bill mentioned, give money to, say, your kids or to charity, I guess it doesn't really much matter. So I don't know. I take a very pragmatic approach to this. Now, having said that, it wouldn't be a decision I would make. But so what, right? I mean, the decisions I make, Bill's not going to make, or you might not make. Again, I don't say that to mean it doesn't matter, because I think it does. But ultimately, what matters is it meeting your financial goals, whether it's, in this case, we're talking about retirement. That's really the ultimate thing that matters the most, right? There were a number of things, though, the papers, and I will link to this paper that he published in 2020. In fact, let me pull it up on the screen, actually. Bear with me while I do that. Here it is. Try to make it bigger. See if you guys can see this. Here it is. So you could just Google it. It's Choosing the Highest Safe Withdrawal Rate at Retirement. He published it in October of 2020. And the chart he's talking about, let's see, what page are we on? Is it here? No, it's actually might be page 4. All right, where'd it go? Oh, maybe it's, hang on. I'm getting there. I promise. This, by the way, this is not the chart, but this is interesting. This paper, what he did was he said, based on Michael Kitz's research, he said, okay, we can look at the CAPE to define whether the market is overvalued, undervalued, fairly valued. And we can draw, there's an inverse correlation between that and your safe withdrawal rate, meaning the higher, the more the stock market's overvalued, the lower your initial safe withdrawal rate, and the lower the market valuation, the higher. But what Bill did in this paper, he added in a second factor, inflation. And And this chart was showing how, yeah, using the CAPE alone, it does get pretty good results, but they're not all correct, because there are times when you notice here, the CAPE is roughly the same in the 14s, but the Safemax withdrawal for each of those periods was wildly different, 5.4 to 8.7. What caused the difference? Different inflationary trends. That's the idea of the paper. And here are the charts. And so what you look at is, okay, if this would be a CPI less than a -5, so that's deflation. And then depending on what the CAPE is, this would be your starting withdrawal rate. So if we had deflation and stock market had completely come unraveled, the good news is you could take out 13% in year one. Of course, the bad news is your portfolio wouldn't be worth much. In any event, if we want to look at today's environment, it's this one right here, figure 10, CPI greater than 5%, right? Because we're at 8.6. Our CAPE Shiller is around 30 something. So we're all the way down here, 20 or greater. So we get down to 4.5. And it's this kind of analysis that he's talking about for his book, for his upcoming edition of his book. So that's the deal. I'm going to go through some more of your questions. A couple of announcements. I've got Harold Ovinsky on the show on Wednesday at noon Eastern time. Again, if you can't make it, just like this one, it'll be up and you can watch it later. Next Monday there'll be no show, but then I'll be back the following Monday. So let's see. Hog Heaven wants to know what value he places on dividends versus total return. He answered that. He's more or less total return. He doesn't see a problem with tilting a portfolio a little bit towards dividends. Although what he said was interesting. He goes, that's okay so long as your total return doesn't get hurt. Well, okay. But to me, what that means is maybe you can tilt a little bit towards dividends, but probably not a lot. And he did point out that there are some behavioral benefits, because that little extra dividend might help you stay the course when, say, like now, stocks are down. All right. Let's see what else we've got. Mel said, that's an interesting way to look at manager fees. I think fewer people would go the direction of AUM if they looked at it that way. Well, and it's something I've stressed for as long as I've had this channel. If you're paying 1% in retirement, effectively your advisor, your investment fee is gobbling up, we'll call it 20 to 25% of your annual income, for at least from your nest egg. You might have Social Security on top of that or whatever. It's a huge number. And I just don't think people don't realize that. And, for a lot of people, it may not destroy their retirement. It'll just cause them to curtail what they can do. And they might not even realize that that's the reason. It comes out of your portfolio. You don't really see it. So, all right, what else do we got here? Fabiano wants to know if the IBonds are worth the lack of potential growth. I don't know that I follow that question. I mean, if right now IBonds have tremendous growth, right? 9.62%. I mean, tremendous under the environment we're in, I guess I should say. But if that were to just crater, let's say inflation flatlined and we went down and maybe, they were only earning 1% or something, you just pull the money out. Right? I mean, you got to wait a year. And if it's before 5 years, you lose, 3 months of interest? But you're earning 9.62% right now. So I don't know. It seems to me like a no-brainer. Maybe I'm missing something. So Don, it's a great question. I didn't ask him specifically. He mentioned a couple, he did mention some short-term bonds. In all of his research that I've seen, he uses intermediate term treasuries, but it doesn't sound like he's in those now. If I understood him correctly, he's all in short-term bonds. I got to tell you, it's one of the reasons I asked him, if he'd back tested, how did he do with this service when you add in fees? I don't know what the service cost, taxes when you're selling in a taxable account. I just really find it hard to believe he's done better than just, a basic index fund portfolio since I think he said he started this in 2008. But of course, maybe he has. I don't know. But he's not done that, analysis to determine that. So he did say that. I'm not sure what this must have been in response to someone else, but Kevin says, I don't hit the like button until the show is over. That way I know if I liked it. Kevin, good for you. There should be no premature like button hitting on this show at all. Okay, well, if you want to hit the like button before the show's over, I'm not going to complain. But way to stand your ground. Don't be bullied into hitting the like button. He probably just hit the thumbs down and shut off the show at that. All right. All right, what do we got? Norse mythology says, please make Cold Warrior a moderator. I don't know how to do that. Do I need a moderator? That might actually be useful. I'm not sure. What powers would the moderator have? It's a question. So Saber wants to know, how often do you withdraw the 4% rule or take your money out? Well, in Bill's research, he just assumes you take it out once a year. Probably just makes the analysis easier. Although it probably could have a notable difference if you don't do it that way. I don't know if he's ever assumed a different approach. You could take it out quarterly, right? You could take it out monthly. But I'm pretty sure, at least in all the papers that I remember, he takes it out once a year in the research. Again, it doesn't mean that's how you have to do it. In fact, one could argue you would have better results if you didn't do it that way, right? Because most of the time, the market goes up. It doesn't feel like that in 2022. All right. By the way, I've got more here, but I want to show you something. I can put links to this below the video when we're done. Two things I want to show you. The first is I found a no penalty CD that I put on my site. Here it is. It's this right here. Now it's through SaveBetter. So you open the account with SaveBetter. What's interesting about SaveBetter, which is an account where you have access to all kinds of different FDIC insured banks. They somehow negotiate these rates with the bank. So like if you went directly to Sallie Mae Bank, I don't think you find this rate. Someone can correct me if I'm wrong, but I'm pretty sure you don't. But this is, so it's no penalty, which means you can pull the money out anytime. Well, you have to wait, I think, 7 days. I think that's standard. And that's probably for regulatory reasons, I'm guessing. But in any event, after 7 days, you can pull the money out. There's no penalty. And it's paying 2.2%. That's pretty strong. The other thing I wanted to mention, I'll put a link to this as well below the video, but Personal Capital, if you're considering it, they're now got a deal where they're giving away a Tesla. And I'll put a link below the video when we're done that gives you the details. All right, what else we got? Brian has this question. I'm not sure I followed exactly. I know he mentions cutting back during a bad market, but does his research state no need to adjust as his research? Oh, I see. Well, it's interesting. So there's theory, right? And then there's reality or practice. So his research, he doesn't alter the district. He adjusts it for inflation every year, no matter what. But I think when he says cutting back when inflation's really high or the market's really bad, what he's sort of tapping into is the reality of the emotional side of the decision and how, that's just, we have to deal with that. And maybe another part that says, look, at least in theory, you could have a period that gets worse than retiring in 1968, and you don't want to wait until we've sort of proven that to start making changes, because then it's kind of too late. But as I asked him, there's no sort of, well, there are dynamic approaches to this that Bill doesn't really research, as far as I can tell. But from Bill's perspective, there's no sort of methodology to follow. If inflation is here, or if the market's there, I think the easiest way to think about it is to, like Michael Kitces had proposed, have some sort of guardrail where you'll calculate the inflation adjustment, but then before you pull the money out, you'll calculate, you'll take that amount that the rule says you should take out, divide it by your nest egg, and if the resulting percentage is greater than, say, 6%, which could happen if inflation's high and the market's down, you'll cut back, and you'll make sure you never take out more than 6%. Now, again, I don't know that Michael, who's going to be on the show, by the way, Michael Kitces is going to be on the show in August, so we can ask him. I don't think he's back tested that. But to me, if you're going to have some sort of methodology, that kind of guardrail, at least to me, makes a lot of sense. And 6% strikes me as reasonable. Certainly, it's got to be the case that the 4% rule would be higher, I would think. So that's kind of the idea. It's interesting, the point. In fact, let me show you another site. If I can remember, is this the right? Let me see if I can find it real quick. He made the point. Oh, I know where it is. He made the point that, he defined success in his research as your money lasting 30 years. But as he pointed out, there were some successful retirements where you almost ran out of money, right? So we've got this site here, ficalc.app, where you can test different scenarios. He said 4.7, right? So let's put in 47,000 on $1 million portfolio. And this actually shows a success rate of 82%, which is, well, you can change the asset allocation over here. So keep that in mind. But, and this is an allocation that's different than what Bill suggests. In fact, let's put this in. He would have said, so we can't break it down between small cap and all that, but he would have said 55, 45, and we'll put 0. That actually makes it, to make it a little worse or better, I think worse. But this will show you not only years when you would run out of money, but years when you'd get close to running out of money. And you can click on this and you get more detail. Look, you're all the way, you're getting pretty cutting the bacon pretty thin down here towards the end of the retirement. So that might be a tool worth, oops, let me hide that. That might be a tool worth checking out. So this is a really important comment. And I think it's true. But the question is, will the future look like the past? And Warren Buffett does invest in international companies, by the way. All right. Yeah, I think that's right, LT. He's taking an approach that's not consistent with the assumptions he uses in in his research that gives us the 4% rule, which, I guess you could take that a couple of different ways. I won't lose any sleep over it. I mean, but the reality, here's the other reality. I've yet to meet someone who actually follows the 4% rule. And by that, I mean, started with a certain percent and blindly adjusts for inflation every year and doesn't ask any questions and always spends that amount. I've never met anyone that actually does that. So I see the research is very, very useful, but not something that you would likely follow to a T. Now, we might not deviate from it as much as Bill does, but all right. I didn't get to ask him this question, but maybe I'll email him and ask him. By the way, I've interviewed Wade in the past, not on this channel, but I do. In fact, I'm going to make a note because I do want to reach out to him. I'm going to do this now. I'll just put Wade's name here. That will, I will email him. You know, I've been emailing with Bill Bernstein, who wrote 4 Pillars of Investing. Let me show you that book. And we're talking about him maybe coming on the show, but it probably won't be until early next year. But he wrote a great book that I read years ago, right here, 4 Pillars of Investing, or the 4 Pillars of Investing. Got to keep the in there. Although Ohio State's trademarked it, so I don't know if Bill will owe them a fee for that or not, because we are the Ohio State University. All right. Lots of good comments. Yeah, I should have asked about tips, Josh, and I didn't. I mean, I asked him if he invested in IBonds. He doesn't. Yeah, I wish I would have asked him that one. Because, and it's important because tips didn't exist in 1994, right? They came out, I want to say, 97 maybe? History of tips. I'll throw in the word bonds. Yeah, 97. Nailed it. First auctioned in January. I don't remember the auction. I don't think I was there. Oh, I should have asked him this question. I couldn't just get through all these. I can tell you there is research on this, Benny. And his research is 30 years. If you look at his original paper, though, he actually tests it for 50. In fact, I can show you that. Let me pull up his paper. Here it is. I use an app called Zotero, Zotero, which is people who use a lot of like researchers and you know getting their PhDs or whatever use it, but it's a way to save research papers and the like. By the way, that's Bill in 1994, and it's free. So I just mentioned that to you if you have any interest in it. But you can see I've highlighted, and you can pull those highlights into different software packages. I don't really do a lot with that. So you can see here years of portfolio asset, number of years portfolio assets last. And you can see there's 40 years, 60 years. So this is, he looks at things for a 50-year period. And at 3%, and this is with a 50-50 portfolio, every single year from 26 to 76 survived the entire 50 years. It's one of the reasons that in the interview, I don't know if you noticed, I mentioned the 3% kind of as a perpetual withdrawal rate. Some would the research actually says it's a bit higher than that. But now when you go to 4%, you can see we have some trouble. I mean, most years it lasts 50, most starting years it lasts 50. Not so much in the Great Depression. There were 3 years there that it fell short. And then in the 60s, it fell short, as you can see. And now he would say that it's interesting, if he used the asset classes he uses today, at 4%, you might get better results here. But yeah, I don't know if that's helpful. I hope it is. I'm not sure, Benny, what you mean by U.S. hedged. Are you talking about hedging currency? I assume you are. But I'm not quite sure. I get nervous about asking someone their thoughts about someone else. I don't know. By the way, so if you follow Dave Ramsey at all, you know that he's said for years that stocks return 12%. And that's created a big brouhaha, including from me, because he's using the arithmetic mean rather than the geometric mean. Well, I assume he is, but I got to show you this. This is from Vangaurd. I've shown this page in the past where, and this isn't the page. What happened to it, Vangaurd? Hang on, I got to do a different. Here we go. Where they show you the returns from 1926 to the present with different asset allocations, starting from 100% bonds, and they go up to 20/80 or whatever, 40/60, all the way up to 100% stocks. Here it is. So, for example, from 26 to 2021, 100% bonds returned 6.3%. That's the average annual return. That's got to be a compound annual growth rate number. Well, guess what you see if you come all the way down here to 100% stocks? 12.3. It can't be just like a arithmetic average, because that wouldn't make any sense. But 12.3, I don't know. Maybe Dave was right all these years. Anyway. Okay. Oh, it's funny. I meant to ask him about Monte Carlo analysis versus historical data. He always uses historical data. And I actually had notes. I still forgot that. All right. No one's perfect. Kevin's going to give me a thumbs down. There's no doubt about it. You know what I'm going to do? So like Harold Avinsky, he's the bucket strategy guy. He's Wednesday. If you have questions, email me. That way I can work them into my outline ahead of time. That'll be easier than me trying to go through the chat. I do need to have a moderator who can go through the chat live, pull out interesting questions, and somehow send them to me. I got to figure that out. If anyone has any good ideas, let me know. This is so true, except I do know who will win the college football national championship. I know every single year, and the answer is always the same. I'm not always right. I will give you that. Okay. By the way, did you notice? Can you see this? Is this in the picture? This was one of my favorite comic books, Rom. I used to have every single one of them. And then I sold them before I went to law school because I needed the money. I since bought the first edition. It looks all fancy in a frame. It's not really worth much money. I'm working on my backdrop. I got to fancy things up around here. All right. Noreen, I will take any advice you can give me. Shoot me an email. So, yeah, let's talk about some more important things beyond the 4% rule. Kenny wants to know if I like Virginia. I love Virginia. So I've lived in my lifetime, Ohio, Missouri, lived in Rhode Island just for a few months when I went to Brown. Virginia, Massachusetts. Virginia is lovely. And I love the Washington, D.C. area. There's some downsides. It's expensive. That reminds me, I wanted to tell you a story. Kind of a scary story. So I play in chess tournaments. And one of the tournaments I often play in is the World Open. And it's every year over the 4th of July. And it's in Philadelphia. There were a few years when it was in the District of Columbia or Virginia. So I was up in Philly this year. I didn't play very well. It was funny. This one kid, So we sit down to play. It's a huge ballroom, and there's, and this was just one of the rooms. I mean, there's, I don't know, 1,000 or 1,500 players. This little young man sits down across from me, and he says, the game hasn't started yet, and he says, it's my birthday today. Happy birthday. How old are you? 8. They're the toughest opponents. I ended up winning that game. I felt bad beating an 8-year-old on his birthday, but this is war. But I can tell you, this kid, if he keeps playing, he will be phenomenal. Anyway, that's not the scary story. I played my last game on Monday, which was 4th of July. I ended up staying over and coming back Tuesday. And at my hotel, I did this last year too. The fireworks start going off at 9:30. And in Philadelphia, I don't know the name of everything. Penn Landing, is that what? I don't know. But they have all these museums and this grassy, park-like thing, and it stretches. And there's is it the Ben Franklin? I don't know what parkway or road it is, but it's really long. I mean, I don't know, a mile. And so you can see the fireworks from where I am. I step outside. I go out this side door of the hotel. It's one of those doors that locks behind you. And I knew that, but the entrance, the main entrance to the hotel is just like you go around 20 feet, go around a corner, and there's the main entrance. So I'm close to that. But I got this side door, and there's this little sort of cove, or it's set back from the main wall of the building. So I walk out of that and walk 5 feet. I'm just on a sidewalk. There's hundreds of people in front of me and thousands as you go closer to the fireworks. There's a police officer. The police were everywhere. And I'm watching the fireworks for 5 minutes, and I notice a helicopter flying around towards the fire, maybe halfway between me and the fireworks. And they've got their spotlight. They're shining on the crowd. And I remember thinking, that ain't good. I'm assuming it's a police helicopter. I can't really tell, but I can't imagine they'd let some private helicopter fly overhead. And I mean, it was frightening. Immediately, it was almost like it was choreographed. These hundreds of people between, say within the 100 yards between me, the first 100 yards from me towards the fireworks, they turn around and start stampeding towards me. And, they're not all running at me, but in my general direction. And it's like it takes your mind a minute to process what's going. Like my first thought was, I see a couple people turn and run. I'm like, what are they doing? And then I realize it's not them, it's everyone. And I mean, in an instant, they're on me. And so like, my first thought is there's a shooter. I mean, what else would cause this? And so your mind starts to race. So it's amazing the things you think about. It's like, is it a sniper? Is it someone in the crowd? What in the heck is going on? And so they're on me in a heartbeat, and they're not on me like they're not running into me. They're running by me. And I immediately, just instinctively, and I know I can't get back in the hotel, I step back in. So like I'm kind of out of sight, so to speak. But immediately people start, just streaming into this thing, wanting to get into the door behind me that I know is locked. There's a sign. So my first thought is I'm going to actually get crushed. If the hundreds of people try to get in to this door, I'm in trouble. But they see that it's locked, and they immediately sort of stream out of this little cove-like area and around the corner towards, out of sight and to the front of the hotel. And I'm sitting there thinking, well, I think I'm okay here. I don't want to join the stampede because I'm probably more likely to get hurt doing that than anything else. Some people, there's kids. There's strollers. And some people are moving quickly, but they're not running. They're trying to remain calm. And I say to one of them, and this is all happening within, what I've described probably took 30 seconds at most. I said to someone, why is everyone running? And they looked at me and said, I don't know. Okay, well, that's a fair answer because I don't know either, and I'm about to start running. So another person comes by, and I asked them the same question. I don't know. And so I kind of let this mass of people going around, and this was, by the way, was all videotaped. This particular scene, there were many of them, but this one was actually on Twitter. You can't see me, it's too far away, but I kind of let the crowd die down around the corner so that I feel safe that I can like leave this little cove I'm in, go 20 feet to the corner and get around. And, you know, I get around to the entrance, and I mean, people are trying to pour in. The door isn't that big. There's a round door that goes slowly. There's so many people trying to get through. It was broken. There's a door literally about this wide that everyone is trying to get through. And you get into it and you're in a glass enclosure with another door. And people are trying to get in with their kids. So I just sort of back away. I'm like, you know, I'm going to let people get in. I didn't feel like I was in danger at that point. Of course, how do you know? But in any event, I eventually got in, went to my room. Unfortunately, 2 police officers were shot. I believe they both are fine. At least last I read, they were. It's scary. And you know me, I'm always, after you take a breath and you calm down and you realize you're okay, and that as far as you know, other people are okay. You know, I of course turn to what lessons I can learn with investing, right? Because that's just what normal people do. But I thought, you know, that's in a way for a lot of people, that's what you go through in a crashing market. Why are you selling? Because everyone else is. That's what we do. I don't know why I made that the lesson from all of that. At least one of them. Yeah, it was frightening. All right. Is anyone still listening? All right. So Virginia is a good place to. Is it a good place to retire? Yeah, I think it'd be a lovely place. Where I live, very expensive, but other areas of Virginia are much less expensive. You know, Southern Virginia, southwestern part of the state. It depends what you want. I have relatives in Blacksburg, lovely town, college town. So you have football there if that's your thing. If you want to take college courses, you've got that. Golf down there. I don't know what you like. Outdoors, hiking, fishing. Smith Mountain Lake is gorgeous. You have friends that have a place there. Lovely. Some would prefer like a Virginia beach scene. Yeah, I think Virginia's great. Taxes are, it's not Tennessee, Texas, or Florida, but it's not California or New York either, so that's good. By the way, on another non-financial topic, I finished the terminal list. Oh, that was pretty good. I'm watching the movie The Hustle with Adam Sandler. So far, it's great. Love it. Bill mentioned using 5 asset classes at 11% each. Why not simply use VTI? Well, the theory would be, so first of all, VTI is just US, right? So one of those 5 asset classes is international. But as for the other 4, which are large, medium, small, and micro cap, I wonder if there's a micro cap index fund. It's got to be. Micro cap US index ETF. I'll look it up. The idea would be you can overweight. So you'd have a greater allocation to mid cap, small cap, and micro cap than you would if you just put it all in VTI. So you're sort of giving up the simplicity of VTI in exchange for asset classes that you think overall will outperform VTI. The problem with it, or I don't know if I say problem, but the reality is we don't know that that approach will outperform going forward, right? iShares has a microcap ETF, IWC. If my internet will work, I'll show it to you. Here it is. I don't know a thing about it. 60 basis points, that's pretty rough. I mean, it is micro cap, but still, I don't understand why it would be so expensive. I wonder what kind of liquidity issues they might have. I don't know. I would definitely look for something else, but yeah, they're out there. But anyway, that's Vangaurd Valuist. That's, I think, the rationale behind it. So Kenya wants to know, if you don't need the money, should you take it out and put it in cash? Well, for my spending, I would take it out as I need it. And just rebalance as I go. But of course, that's part of my answer for me to that question is based on the fact that, I've got 20 or 30%. Well, now it's a little bit less, but if I were fully retired, I'd have a fair amount in fixed income. If I had a 100% stock portfolio, I probably would take out some number of years to have in cash, just as a general, well, no, as I say that, it still doesn't work, because then effectively you're just taking money out every year from stocks. Well, I wouldn't have a 100% stock portfolio. Even if I were accumulating, I wouldn't. But in any event, that's my approach. I'd take it out as I need it. That doesn't mean it's the right approach, but. Now, I think what Bill would say, what he did say was he's going to take it all out and use it, because even if he doesn't use it, to spend on himself, he'll give some away. But that's not everybody, so. Craig, I don't have any bumper guard suggestions at this point, but it's definitely something I'll be talking to Michael Kitsis about when he's on the show. And I've thought about, this can't be that hard. Bill mentioned he uses spreadsheets that he's built over the years. It's not that, you could start with Stern Business School. They have a spreadsheet with S&P data and I think REITs and corporate bonds and bills and intermediate term treasuries going back to whatever. It shouldn't be that hard to build a spreadsheet that allows you to calculate all of this automatically. You have to put some formulas into it. It's on my to-do list, but and we should be able to program it to deal with guardrails. How to do that? See, I'm gonna make another note, but if anyone wants to help me with that, I don't know. Build spreadsheet to test 4% rule and guardrails. I tag that as GTD for getting things done / someday. By the way, I've got a really cool, I've started using, I love note-taking apps. I'm kind of addicted to them, but I started using Noteplan version 3, their current version. I'll show it to you. I really like it a lot. I don't know if it's just for the Mac. It might be just for the Mac, but it's kind of a combination of Zettelkasten note-taking with task management, and it links in your calendar. It's got a great user interface. We'll see if I'm using it 3 months from now, but really like it a lot. And I've tried a lot of note-taking apps. Oh, and you save it locally, or you can have it in cloud to sync it. But it's not some proprietary database where if Noteplan goes out of business, you've lost all your data. Yeah. No one asked me that question, but I thought I'd answer it anyway. Oh, that's interesting. So I mentioned the 2.2% rate might not be available on Sallie Mae. Gary says it is, but with penalties. So yeah, that's the thing. I'll show you Save Better. People have asked me about it. They're an advertising partner. I didn't put any links below the video for them. I can after the show. But Save Better. So in Europe, it's called Raisins, same kind of idea. But they have all these different accounts. You open the account with Save Better, and then you can put your money in whatever accounts you want. So they got Ponce Bank. Here's got a 1.75% money market. You've got some fixed, and there's others as well. You've got some fixed term CDs, and then these no penalties. But the point I was going to make is you usually can't actually find these on the bank website itself. It's only available through Save Better. So as the commenter mentioned, I think I got rid of the comment. But in any event, 2.2 is available in Sallie Mae, he says, but not in a no penalty CD. Keep in mind the way these no penalty CDs work. Like any CD, think of it as lump sum. Like with savings account, you can put in $100 a week if you wanted to, or whatever. Keep adding to it, you take away, you add. That's not how a CD works. You put a lump sum in, you take a lump sum out. You do the hokey pokey, well, whatever. It's it's a lump sum. I don't know what's wrong with me. It's probably another thumbs down from Kevin. It's a lump sum in and a lump sum out. So if you want to take something out, you got to take it all out. Now you could open up multiple CDs. I don't know if Sallie Mae has a limit. Maybe some banks do. You can only open up so many. I don't know, but it's but yeah, I mean, if the rates go down, yeah, you just keep it in there for the 14 months, I guess, unless you need it. If rates go up, you can pull it out and put it in something with a higher rate. That's why, like, look at this. I don't really get like you could do it 1.85 no penalty for 10 months, but I'm not sure why. I'm trying to think of a situation where you'd actually pick this over the 2.2. Maybe I'm just not smart enough to puzzle through that. It's got to be an answer to that. Anyone smarter than me that can answer what the scenario would be in a no penalty context to take a lower rate for a shorter period? I'm so confused. All right. What time is it? It's 8:35. Wow. Well, now I'm just going to skip ahead because I'm tired. It's exhausting. I have a question for you. So I get contacted from potential advertisers all the time. Most of it's for the website, not so much for YouTube. But I got one of them that's reached out to me is this site called Playbook, which I think is an odd name. But basically, here it is. Basically, there's a fee. I think it's $19 a month. But basically, you can create a financial plan here. And I guess you connect your accounts. It looks at like, your different retirement accounts and optimizes everything. I'm actually going to try it. Like I said, I'll be the crash test dummy. And they even offered me like, do you want a free account? No, I'm going to pay for it. Don't give me anything free. But if anyone's used this, I don't know if, I like to, as best I can, I like to use things. If it's a bank account, I don't need to open up the bank account to understand how it works before, I would promote it, whether they're an advertiser or not. I mean, most of the banks I promote are not advertisers. In any event. So I want to use this, but I'm curious if anyone's used that and has any thoughts on it. I'd never heard of them before. Fabiano, I don't know why that would matter from a compounding. The compound's the same. I mean, the taxes are different, of course. But I don't know why holding an S&P 500 in multiple account types would affect anything in terms of the actual compounding. This is a vote for Arizona over Michigan. I would tell you Northern Michigan is beautiful. Mackinac Island, they misspell it. They can't spell it right. It's not spelled correctly. It's just, let's put that out there. Beautiful. But Arizona's lovely too. I usually go to Scottsdale for spring training every year, although we haven't been. The last time we were there, we landed in 2020 on the day, like 3 hours later, they canceled baseball after my son and I landed in Phoenix. All right. All right, gang. So again, we got Mr. Ivinsky on Wednesday at noon Eastern time. No live show next week. I will add some links to this video here in just a minute, including, I had a link to Bill's paper that we referenced. I'll add a link. I'll put a link in there, an advertiser too, to the personal capital Tesla thing. If you're interested in that, you can at least look at the details. And I'll put a link into my savings page where it's got the Save Better 2.2 Sallie Mae, but I'm working to track everything, trying to find the best rates. And if you know of better rates, I want to know them. I don't care if they're an advertiser or not, they go on the page. That's my goal on that. So I'll add those to the show. Won't have a show or to the video below the video. Won't have a show next week. But we'll be back. Pretty sure I'll be back the week after, right? Let me just double check. Yeah. So no show on the 18th. Got a show this Wednesday, the 13th at noon with Mr. Avensky. No show the 18th, back the 25th. You know, Lord willing and the creek don't rise. So there you go. Hope you're having a great week. I hope you enjoyed I really enjoyed, getting to meet Bill Bengen and talk with him. And I find it fascinating that he takes approaches that are really contrary to his research. But, there's a reason they call it personal finance. And we each have to make our own decisions that we're comfortable with. Yeah, that's okay. There you go. I think your job is to just take it all in and evaluate it. Think about things I say, maybe not. What he says, what other people say that you think have something to add to the conversation, and you make the best choice you can. I mean, what else can we do in this life? That's about all we got. All right, gang. Appreciate you watching as always. Have a great week. And until next time, remember, the best thing money can buy is financial freedom.